Hi, I'm Monica Young. I'm broker of Just Global and host of Global Real Estate Investor Club. While Europe's central bank has started reducing rate to 3.75% from a record high of 4%, will the Fed in US start reducing rates soon? How do we conduct 1031 exchange at a high interest rate environment? So today, I have invited Mr. Ron Ricard, who is the Vice President of IPX 1031, Northern California. Ron is the designated certified exchange specialist. And since 2002, Ron has taught 1031 exchange classes to over 30,000 investors, real estate agents, and others. And Ron is a professional when it comes to helping to understand the 1031 exchange rules and regulation. He has served on board of the Santa Clara County Association of Realtors and the Commercial Broker Association. And he's very involved with many real estate association and industry groups throughout Northern California. So let us welcome Ron. Hi, Ron. Thank you very much for accepting our invitation. Now you have the forum.
Thank you very much for having me, Monica. I always love talking to your group. It's been a while since I've done it in person, but it's always fun to talk to people who want to hear about 1031 exchanges. So let me go ahead and, oops, sorry. All right, can you see my screen?
I can. Yes.
Come on. There we go. Sorry about that. It's Saturday morning. My computer didn't want to wake up very much. Anyway, so again, this is Ron Ricard with IPX 1031. We are going to go over 1031 exchanges, the rules, the process. We're going to go over some of the special things that people need to know, some of the what I call the nuance items. Let me start by saying a couple things. First off, I always get the question about whether 1031 exchanges are going away. If any of you read the real estate news, there's always something in the presidential budget about limiting 1031 exchanges. So there's a fear of, is anything going to change? And the answer is no, nothing is going to change, at least not in the immediate future. Right now, Congress has absolutely zero appetite for any kind of major legislation. Now, I would expect there probably will be some kind of tax legislation next year because many of the Trump tax cuts from 2017 are expiring. So there might be some legislation next year, but until we know how the elections turned out in November, we have no idea what those are going to look like. But as far as 1031 goes, I really don't expect to see any substantive or any real changes at all to exchanges. 1031 has been around for more than 100 years, and it survives so far pretty much intact. If anything, they've made it more usable than before. So again, I don't expect anything to happen with regard to legislation and 1031 exchanges. So don't feel worried about that. I would tell Monica, I'm not looking for a new job. So anyway, so 1031 is the part of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer, you get to defer paying the taxes on the profit that you made. Excuse me. Go, leave. I'm talking.
Ron, we did not see the PowerPoint move. So
no, it hasn't. Don't worry. Sorry about that. My 5-year-old granddaughter decided to bring me my mail. Sorry about that. No anyway, no, so it hasn't moved yet. So anyway, so 1031 is a part of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer paying taxes on the profit that you've made. So you have a rental house, you want to sell that and buy a duplex. So you call Monica, she lists the property. When escrow closes, the money comes to a third party called the intermediary. That's a company like us. You then go ahead and find the replacement property that you want to purchase. We send the money to the title company on that side, and that's your exchange. You sold a piece of investment real estate, you bought a piece of investment real estate. And because you never touched the money, because we had it, you get to defer paying taxes on the profit that you've made. Now, important word there, defer, not eliminate. So if you sell a house to buy a duplex, later you sell the duplex to buy a fourplex, now you're tired of real estate and you pay and you just want to pay the taxes. You pay taxes on the house, the duplex, and the fourplex. It is just deferring taxes. It is not eliminating the taxes. And the reason that it's important to know that is that, a lot of people think of 1031 as a way to avoid paying taxes. It does to some degree, but the question I often get is, well, if I'm going to have to pay the taxes anyway, why bother doing an exchange? And there are two reasons we always want to look at doing a 1031 when we sell our investment real estate. First is, do you want to pay your taxes today or tomorrow? The answer for most people is tomorrow. So the way I look at it is this. If I make $600,000 of profit on a property, on average, I'm probably going to have to pay $200,000 of that in taxes. Now, what would you prefer to do? Pay $200,000 to the government or use that $200,000 to buy more real estate? Most of us would prefer to keep the money and buy more real estate. But the real reason we do the exchange is ideally we never have to pay the taxes, because sadly one day we're all going to die. And when we die, we win. When we die, actually our kids win, because when we die, whoever inherits the property from us gets what's called the step up in basis. Make sure we all understand this. I bought a property many years ago for $100,000. Today it's worth $1 million. If I sell it, I have to pay taxes on that $900,000 in profit. But the day I die, whoever inherits the property from me, their basis is the value of the property at my time of death. And if your kids are like mine, the day after my funeral, they sell everything. And so when they sell it for $1 million, how much taxes do they have to pay? Zero. All the taxes that you would have paid when you were alive all disappear when you die. So that's the real beauty of the 1031. Now, please note, this does not work if you give real estate to your kids or add them to title on your property. This only works if they inherit the property. So that's why it's much better to inherit property than it is to have it gifted while you're still alive. All right, let's stop talking about death now. So there's a term you often hear in 1031, and that term is like kind. What you sell and what you buy have to be like kind. That's a very misleading and very confusing term. Any kind of investment real estate can be exchanged for any other kind of investment real estate. So you can sell your rental house and buy a commercial office building or shopping center. You can sell a farm and buy an apartment building. You could even sell bare land and buy a rental property. Any kind of investment real estate for any other kind anywhere in the United States. And you are still deferring both state and federal taxes. So it's much more flexible than most people think. That we use the term like kind because we think of when we used to do exchanges for things other than real estate. In my 20 plus years of doing this, I've done exchanges for airplanes. So when you sell an airplane, you have to buy an airplane. Farm equipment, sell farm equipment, buy farm equipment. So when you do an exchange like that, that's what like kind meant. If you sold a piece of art, you had to buy a piece of art. Sold a boat, you had to buy a boat. Now in 2017, Congress completely eliminated 1031 exchanges for everything except real estate. So now 1031 is only about real estate. So that term like kind really is not needed anymore, but many people still will use it. So again, the key here, any investment real estate for any other investment real estate. Now there are a couple of other things that we wouldn't consider necessarily, but is leases. For example, much of the land around Stanford University or on the island of Oahu, the land is owned by a company or a family, and the buildings on there are leased. Well, does that building qualify as real estate for 1031? Yes, as long as the lease is at least 30 years long. So if the lease is at least 30 years long, then it is considered to be real estate. Also, I've done a lot of exchanges lately on people selling permanent easements or buying permanent easements, such as conservation easements, water rights, mineral rights. I did an exchange for a big farming company out in the Central Valley where they sold a flooding right. But again, as long as it's a permanent easement, it's considered to be real estate. So that does qualify also. So there are some nuances. Again, it is associated with actual pieces of real estate, but it doesn't necessarily have to be the specific real estate that you're selling itself. Now, I did say, though, it has to be investment real estate. So what kind of real estate is not investment? Well, we all think of our primary residence. Our primary residence is not investment real estate. A primary residence has a completely separate tax rule. Now, many years ago, when you sold your primary residence, you needed to use that money to go buy another primary residence. That law is gone. Now, when you sell your primary residence, you get an automatic exemption, and it doesn't matter at all if you buy another property. If you're single, you get to keep $250,000 of capital gains tax-free. If you're married, the married couple gets $500,000 tax-free. If the gain is more than that, then they pay tax on that excess amount. So if you bought it for $200,000, now you're selling it for $1 million, you have $800,000 of gain. Assuming you're married, you get to keep $500,000, you have to pay tax on the other $300,000. Now, that was a lot of money back in 1997 when they established that law. Nowadays, though, $500,000 is not very much, obviously, especially here in the Bay Area. So most people who've owned their house more than a few years have capital gain way in excess of that $500,000. So is there anything else that you can do if you don't want to pay taxes? Yeah. First off, do you have any portion of your property qualify? Do you live in a duplex where you live in one side and rent out the other? Do you have an ADU? Do you rent out the basement? For many people who are realtors like Monica, she probably has a home office. So the key here is, what are you declaring on your tax return? If you are declaring 20% of your property as rental property or home office or some kind of business use, then 20% of your sales price you can do an exchange on. So using this example, you're selling a property for $1 million, you're declaring 20% of it as investment. So 80% or $800,000 gets treated like a primary residence, and you get your $500,000 exclusion against. And the other 200, you can do a 1031 exchange with and use that either to buy a standalone piece of investment real estate or exchange back into another house that's also going to be used for home office or ADU or whatever. Again, the key here, though, is you are declaring it to the IRS as part of your tax return that a portion of your property is used for business or investment purposes. And by the way, one thing I do want to mention, I don't know if Monica mentioned at the beginning, if you have any questions, please put them in the chat box. Once we're done with the talk here, Monica and I will go through the chat box and answer any additional questions. So please put them in the chat if you have any questions until then. All right. So the truth is, though, most of us do not have an ADU. Most of us do not have a home office. So if you have a very highly appreciated primary residence and you feel stuck because you don't want to pay the government hundreds of thousands or sometimes even millions of dollars in taxes, what do we tell you to do? Move out. Turn your house into a rental property. Now, after you've been renting out the house for a couple of years, is that house now an investment? Yes. Is it still considered to be a primary residence? The answer is actually yes, because the definition of primary residence is one that you have lived in for 2 years during the last 5. So as long as you can say that you have lived in the property for 2 years during the last 5. So if you sold your property today, June of 2024, you look back to June of 2019, in the last 5 years, have I lived in the property at least 2 of those? If the answer is yes, you could take advantage of both tax rules because you qualify for both. So if your property sells for $2 million and you're married, you get to keep $500,000 and then do an exchange on the remaining $1.5 million. So again, this is a strategy if you have a highly appreciated primary residence that you feel trapped because you don't want to pay taxes on. Now, of course, this does not work for everybody. If you need the money from your house to go buy a bigger house, it's not going to work. Also, note that you are not just reinvesting the excess profit. You are reinvesting the entire sales price minus the exemption. So I had this actually happen a few years ago where a man sold a house for $20 million and he was single. He got to keep $250,000 and did an exchange for the remaining $19.75 million. Okay, so even though his gain wasn't nearly that much, you still have to do an exchange for the entire sales price minus the exemption. But again, this is a strategy. And I do want to point out that this is becoming a very common strategy. I probably set up 2 or 3 of these every single week. It's getting very common. All right, what other kinds of properties don't qualify for 1031? Well, sometimes we will have people who flip real estate. They buy something, they fix it up, and they sell it. I'm sure Monica has some clients who that's their specialty, where they buy a property, fix it up, and sell it. That does not qualify as investment. Same thing with development. Buying a piece of land, building a house, and selling it, not considered to be investment. Both of these, the IRS considers to be property held for resale. In other words, you bought it because you know you wanted to sell the property, not property purchased for investment purposes. So, also, you cannot exchange into any kind of REIT or partnership because those are not considered to be direct ownership of real estate. I will at the end talk about some structures that do work for 1031, but REITs and partnerships do not, because it's not considered direct ownership of real estate. Also, second homes do not qualify. Now, vacation rentals, which we'll talk about in just a minute, do qualify, but second homes do not. And most of you are thinking to yourself, well, I don't have a second home. But you do, because a lot of times second homes are also properties that you are allowing family to live in, and they're not paying you market rate rent. So if you have a family member, a parent, or a child, or a brother-in-law who is living in a property and they're not being charged market rate rent to the IRS, it's a property held for the benefit of the family, and they view that as a second home. And therefore, that does not qualify as investment real estate, therefore does not qualify for 1031. So when you go home, or if you're at home and your kids are living in one of your condos rent-free, call them up and tell them that you need to start charging them rent. It's good for them, it's good for you too. Vacation rentals also do qualify for 1031, but the IRS has actually given us a firm definition of vacation rental. I refer to it as the 222 rule. You and your family cannot use the property more than 14 days or 2 weeks every year. You must rent it out at least 2 weeks per year, and you must do this for 2 years. So if you have a property that you would like to convert to a personal use and you can use it as a vacation rental, we actually have a recipe from the IRS how to do it. As long as you don't use it more than 2 weeks, rent it at least 2 weeks, and do that for 2 years. After 2 years, you can do pretty much whatever you want. So this is very good for those of you who have property in like Las Vegas or Lake Tahoe or Hawaii, where you'd like to use it as a vacation rental. Now, let's get into a couple of the important terms when it comes to the 1031. There are 2 things that are very important in an exchange. How long do you have to buy the next property, and how much do you need to spend? So the first one is, how long do you have? These are far and away the most important numbers to know about when you're doing an exchange. From the day escrow closes, you only have 45 days to identify, to tell us what you are going to buy. You have 180 days, about 6 months, to actually buy it. So 45 days to tell us what you're going to buy, 180 days to close escrow. Now, what does identify mean? Identify means you are giving us the exact address to what you're going to buy. It's not a house in Milpitas. It's the exact address to that house. Now, there are different rules, different numbers of properties you can identify depending on what you want to buy. For most people, you can identify a maximum of 3 properties. So I often get the question, do I have to be in contract on my property within the 45 days? The answer is technically no. Technically, you have just given us a list of 3 property addresses. However, if on day 46, all 3 of those properties get sold to somebody else, then you're out of luck because that property doesn't qualify because they've been sold to someone else. You cannot re-identify. Once the 45-day clock has expired, you have to buy from that list you've given us. No extensions, no exceptions, no excuses. So even though technically you do not have to be in contract by the 45 days, I always say it's a very good idea to be in contract, to have your inspections done, your loan approved. You want to be locked into a property by the time you get to that day 45. Now, mind you, that 45-day clock does start at the close of escrow. So is 45 days a lot of time? I think even Monica will say, no, it is not. Especially in today's market, there's very little inventory locally. And so there isn't a lot of, there are a lot of people who are afraid of not finding a property within the 45 days. So 2 things I do want to point out about that clock. Again, it starts at the close of escrow. So ask for a longer escrow. If the buyer wants to close escrow in 15 days, tell them no. I want 45 days. I want 60 days. I want longer time to allow you to find your replacement property. I would say that probably half of my clients are in contract to buy something by the time theirs sells. That's okay. You could be in contract anytime. All that matters is that you close escrow on the one that you are selling first, then you close escrow on the one you're buying, then it's a regular exchange. Now, I will also say there is a second way of doing this, which is called a reverse exchange. I don't want to go too deeply in this, but I want you to know it exists, where if you find a property that you want to buy and you must close on it before you can sell your property, there is a way to do it. It's called a reverse exchange. It's more expensive. It's a little more work. The main thing is you can't buy that property and then call me, because if you do, I will hang up on you, because you have to buy that we have to buy that property for you. In other words, you come into escrow with the money to buy that property. We take title to that property and hold it for the 45 days. I mean, for the time until you sell your property. Now you have 180 days, 6 months to sell your property. Obviously, the biggest thing here is the money. If you have the money to do it, great. But getting a loan is very difficult because most lenders will not lend into a reverse exchange. But again, if you have a situation where you want to buy first, either because you found that perfect property or you're just afraid of not being able to find a property in the 45 days, call me and we will go over your situation. There are different ways of structuring it and different ways of financing it. So give me a call. We can discuss it. Again, I just want to let you know that that does exist. All right, next question. How much do you need to spend in the next property? The answer is simple. All of it, not the equity, not the profit. You have to buy equal or greater to what you sell the property for. So if the property sells for $1 million, you need to buy for at least $1 million. Now, can you buy for more than $1 million? Absolutely. There's no upper limit. Can you buy for multiple properties that add up to $1 million? Yes, you can. Can you buy for less than $1 million? The answer is actually yes, but you pay tax on the difference. So if you sell for $1 million but only buy for $900,000, then you pay tax on that $100,000 difference. So it is okay to buy less. Just know that you'll pay tax on whatever that difference is. Also, all of the cash, all of the equity that comes from that sale, all has to go as a down payment on the next property. If you get too big of a loan and you have cash left over, you pay tax on whatever that remaining cash is. In today's market, as Monica alluded to at the beginning, not too many people are getting too much loan because of the higher interest rates. However, especially the market we came out of where interest rates were very low, a lot of people were maximizing their loan amount, and some got too big of a loan. Then that is then they pay tax on whatever that remaining cash was. But again, equal or greater, use all the cash. Obviously, if there was a loan on the property, that loan is going to get paid off when you buy the next property. So you need to make up that loan when you make up the difference. So let's go back to our example. You sold $1 million property. It had a $300,000 loan on it. So you have $700,000 of cash. So you need to buy something worth at least $1 million. You need to put that $700,000 as a down payment, and then you can come up with the other $300,000 however you want. Historically, most people just get another loan to replace the loan they had. But as Monica talked about at the beginning, with high interest rates, people are trying to find other ways to do it. So one thing we are seeing a lot of people do is they're using their own money, their own cash, instead of getting a loan. That's okay. Also, I'm seeing a big uptick in the number of people doing seller financing on the purchase side. We'll talk about it on the selling side in just a minute, but if the seller of the replacement property is willing to carry a note, then you could often get better interest rates doing it that way. So again, the key here is you do need to make up the difference of that loan, either with another loan or with cash from your pocket, but equal or greater to the entire sales price. I don't care what you bought it for. I don't care what the repairs were. All I care about is what are you selling the property for? So in a nutshell, that is the 1031 exchange. You're selling investment real estate. You're buying any other kind of investment real estate anywhere in the country. You need to know what you're going to buy in those first 45 days, and you got to buy equal or greater to what you sell. Otherwise, that's about 98% of all the 1031 that most people need to know. Now, there are what I call the red flags, the common problems people have when it comes to exchanges. And the first one is family. There is a restriction actually in the tax code on buying and selling property among family members. Actually, I'll say specifically, it's about buying from family members. Now, it could be also a corporate relationship or partnership relationship. There are different kinds of related parties, but primarily today we will talk about family. Now, family is your immediate family: parents, grandparents, children, brother and sister. Immediate family. Your uncles and your cousins are not considered to be related to you for this purpose. But if you want to, for example, I have a couple of situations where I see it very commonly, where someone wants to do an exchange and buy their children's house from them or buy their parents' house from them. You can't do that because that restriction of buying from a family member. And this is something that on the tax form itself, you have to confess your sin. You have to admit on the tax form that you purchased from a related party. So it's not something that you can hide from the IRS unless you commit tax fraud, which we do not recommend. So that's one. Another common reason people will think that they want to buy from a related party is they're trying to avoid a reverse exchange. So let's say there's a property you want to buy. You have your father buy that property and hold it until you sell your property. Then you buy it from your father. Cannot do that because you would be buying property from a family member. That does not work. So again, the key here is that any kind of transaction where you are buying from a related party, such as family, please call me. In some limited cases, there's a way to do it, but it's pretty rare. Seller financing. Seller financing is something that we are seeing more of these days, where the buyer is asking the seller to carry a note. The key is this: seller financing, if you are just cashing out, is fine, but seller financing, if you need to buy a property yourself, you want to go do an exchange yourself, does not work because that note will become taxable to you. So please note that you do not want to do seller financing if you are also doing an exchange. Next is vesting. What is important in an exchange is it has to be the same taxpayer selling and buying. So if Monica sells, Monica buys. She cannot give the money to me to buy the replacement property. Now, the key here, though, is most of us, us and our trust, our revocable trust are the same taxpayer. So that's not a problem. However, if you own property with other people, the first question I'm going to ask you is, do you own this property in a partnership, or do you own the property as what's called tenants in common, where you each own a percentage of the property? If you each own a percentage of the property, then when that property sells, each one of you can do whatever you want with your individual share. But if you own the property in an LLC or a partnership or some entity like that, that has to be the entity doing the exchange. So corporation sells, corporation buys, partnership sells, partnership buys. If you want to dissolve the partnership and each go your own ways, that's very risky and very difficult to do. So if you have a situation where you have a partnership and you're planning, I repeat, planning to sell the property, please call me. We'll go over what to do. If you're closing escrow next week and you want to dissolve the partnership, not much I can help you with. So again, the key here is that it needs to be the same taxpayer selling and buying. Another thing to be very careful about is the intermediary. What we do is not regulated. So please make sure you only work with very large, very safe companies. I mean, it does not cost very much to do an exchange, just a few $100s. For us, it's $1,000. But some people think that they want to save $100 by finding somebody online. That's usually a very bad idea, because those companies usually do not have any kind of bonding or insurance or any kind of guarantee your money is being protected. So you always want to work with big companies. This is one where size does matter. Last thing to be careful about are foreign sellers. Now, it is perfectly okay for foreign sellers to do an exchange. That is not a problem. Now, by foreign sellers, I mean somebody who does not have a U.S. citizenship or U.S. A permanent residency, green card. Also, this has to do with foreign corporations. Now, any entity can do an exchange, but if a foreign person wants to do an exchange, first off, they must have a Social Security or tax ID number. If they do not have a tax ID number, they cannot do an exchange. Also, there's additional forms to be filled out and submitted to the IRS. The other part of it is escrow is most likely going to have to do some withholding on the sales price, called FERPTA. And that withholding cannot be avoided just because you're doing an exchange. So again, the key here is that the key here to note is that foreign persons can do an exchange. You just want to make sure that you let us, the title company, us, the exchange company, and the title company know early in the process to make sure that you get everything done. For example, if you do not have a tax ID number, you can apply for a temporary one. It takes a few weeks to get, but there are ways to get it. Okay. So those are the things I always want to tell people to be careful about if you're doing an exchange. Now, why do people do 1031 exchanges? And it's not necessarily for the reason you think. You don't do an exchange just to defer taxes. You also do an exchange because you want to buy something better. Now, what does better mean? Better means whatever you want it to be. It could be, I want to sell my big apartment building to buy 3 houses. Better might be, I want to sell my 3 houses to buy 1 apartment building. Better might be, I'm moving to Arizona, so I'm moving my rentals to Arizona. Better might be, I'm looking for better cash flow. Today's market, a lot of people are selling in the Bay Area to buy in markets where they can get better cash flow, better income for the amount of property they have, especially during COVID. We saw prices go up 50, 60, 70% in many markets in the Bay Area, but rents stayed pretty flat. So we did a lot of exchanges where people went into markets or kinds of properties that generated better income. Another thing, a lot of people are, when they get older, are tired of owning real estate, so they're looking for something with less management. We'll get into that in just a second. I also do a lot of exchanges for people who are looking for 1031 as an estate planning tool. So if, for example, if you're in your 80s or 90s, usually is when this started happening, where people don't want their children to fight over their property, over their estate when they pass away. So instead of having them each own a third or half or whatever, how many ever kids you have, of all of your real estate, you do exchanges so that one kid gets one property, another kid gets another property, and there's no fighting among family members. So we do 1031 exchanges as an estate planning tool. It's one of my favorite exchanges I do. But again, the key here is that you don't do an exchange just to defer taxes. You do an exchange because you want to reposition your money. You're doing an exchange because you want to buy something better. And that term better is subjective. It's whatever you mean by better with your real estate. 1031 is the tool that allows you to get from the real estate you own today to the real estate you want to own tomorrow. 1031 is a very powerful tool. Again, it's been around for more than 100 years. And real estate is literally the only thing that you could own and sell at a profit and not pay taxes, as long as you're using that money to buy other investment real estate. Now, as I mentioned earlier, one of the big reasons people do exchanges is because they're tired of owning real estate. And so a lot of people, when they are about to retire or have retired, are looking for exit strategies. I'm tired of managing my real estate. What else can I do? Well, you could always pay the taxes. Not my recommendation, but a lot of people do just cash out. Dying is a good tax strategy, but I don't recommend it. Seller financing, I think, is a very underutilized tool for exit strategies. My father did this. When he retired, he was he's a very hands-on manager. He was the kind of guy, he had to do his own real estate. When he retired, he says, I want to travel, I want to do things, I don't want my real estate anymore. So he found buyers who were willing to pay him instead of paying a bank. And the advantage of seller financing, if you're cashing out, is that instead of paying all your taxes at once, you only pay taxes as you receive payments. So in my father's case, he's stretched out his tax payments for 20 years while the buyer was paying off that property. So seller financing, I think, is a very underutilized tool if you're just trying to cash out. We also see a lot of people exchange into property that they're later going to convert into a property that they're going to move into. Now, so let's say you're about to retire and you know you're going to retire to Hawaii. So you do a 1031 exchange, you buy that condo on the beach in Hawaii. Now you must rent it for a few years before you move in, but then later you retire and move into that property. Now the question I know everyone is always going to ask, well, how long do you have to rent the property for before you move into it? The answer is the tax code does not give us a specific amount of time. Most accountants recommend at least 2 years, but again, that's something you need to be discussing with your tax professional. It is a gray area in the tax code, but this is a very common strategy people have these days of buying a property that they're later going to convert to their personal use. We talked about using the 1031 as an estate planning tool, basically lining up what they're going to buy. Also, a lot of times people will exchange into properties that's what we call low maintenance asset. The first one on there is often referred to as triple net. Sometimes it's called net lease commercial real estate. That's where you sell your rental house and you go buy a McDonald's, or you go buy a Walgreens or a Jiffy Lube. The key here is that you are exchanging into a building and land that you're leasing to a big corporation. You're not buying a McDonald's franchise. You're owning the land underneath it and leasing it to them. It's referred to as triple net because the tenant pays the property taxes, all the insurance, and does all the maintenance. So it's very low maintenance, usually very long contracts, sometimes 30, 40, 50 years. I mean, most of them I see these days are 15 to 20 years. But again, you do not have to do anything with these properties because the tenant takes care of the property for you. So that's a very common thing people get into, especially if they're selling multi-million-dollar properties. Now, the reality, though, is not everybody has multi-million-dollar properties, or they don't want just one. So the other asset class that people are buying these days are what's called a Delaware statutory trust. Sometimes it's structured as a tenant in common, but most of them these days are structured as a Delaware statutory trust. A Delaware statutory trust is fractional ownership in commercial real estate. So there are companies out there who will buy very large properties, 50 million, $100 million properties. And then they will come to the market and ask anybody who wants to buy a percentage of it, a fraction of it. And you can buy usually as little as $100,000 worth of a multi-million-dollar property. And so, and the sponsor, as these are called, they take care of the property. They act as like the general partner. But the key is this does qualify for 1031 because you have a specifically deeded interest into a particular piece of real estate. It's not just, a bunch of Walgreens across the country. It's a specific Walgreens that you own a percentage of. So again, the key here is it does qualify for 1031. It's predictable cash flow. Now, it is not for everybody. The biggest negative to them is it's not liquid. It is not a place just to park your money until you find something better. Usually you're in these things until the managing partner decides to sell, which is usually 4 to 8 years. So it's a long-term hold. It is not something that you can get out of very easily. So anyway, these are just some of the assets, or just some of the ways that you can get out of actively managing real estate if you're at that point of life where you just don't want those properties anymore. And with that, that's the end of my talk. And I'm going to open it up now to questions. Monica, how do we have any questions in the chat box?
Yes, we do have some questions in the chat box. I'm going to read it to you. And so, and I'm sure that like others, if they have other new questions, they can type it in the chat. So the first one comes from one of the attendees. She's asking if she sell and trade into many properties, say 1 into 3, what if not all 3 of them close in the time window?
Well, in that case, she only bought 2.
So like the restriction is like 45 days to identify and then 135 days to close if you
135 additional days for 180, correct? Right. So let's say that she identifies 3. Make it simple. She sells a $3 million property. She identifies 3 $1 million properties. It's now after day 45. 2 of them close, and for whatever reason, the third one doesn't work out. Well, now effectively she bought 2 million out of the 3 million, so she pays tax on that other $1 million that she did not spend. So unfortunately, there's no extensions or exceptions if the property isn't ready by the 180 days. Now, the reality is, usually when we run into problems with 180 days, it's because you're buying new construction. And especially during the pandemic, we saw a lot of new builders not finishing properties because they couldn't get windows or certain things to finish the property. So that was we saw a lot of exchanges fail because of that. But usually, if you've identified property properly by the 45th day, usually you are you can close usually within the 180.
Yes, I agree. So I'll have to really monitor it. So the second question, I think, is a little bit more for property manager. What is the period of notice required to provide notice to a current lease tenant in California?
That's beyond my expertise, Monica.
Yeah, but I can answer it. So if it is like 1 year lease, that only 1 year lease, you can give 30-day notice. If it is more than 1 year, you're required to give at least 60-day notice. But of course, if it is Section 8, then of course you have to contact the housing regarding the notice period. Yeah,
and also if you're in a market like Oakland or San Francisco, the rules there, they have more tenant right type things. Those can be even more onerous. So do be careful in certain markets.
Yes, agree.
Okay. By the way, one thing before we go to the next question, I'll go back to the screen here just a second. I just want to make it okay, make sure people know it's okay to call me. I'm here to answer questions. Feel free to, the phone number is my cell phone, so you can text, you can call me, you can send me email. I'm here to answer questions. My job is to help you be successful in your exchange. So feel free to reach out to me and answer any questions that you might have. Anyway. All right, so let's go to the next question, Monica.
Yes. Okay, so that's a question from another attendee. So like, let me just, Sunny, it is gone. So basically, with that question, I think that, sorry. Yeah, because my screen is kind of lost a bit. So basically, I remember that what he asked is like, say, sales price is 800K, and then the sales course is 100K, and then there's a loan of 200K. So the purchase price is 500. Maybe you can tell him a bit on how much would be the cost, he has to, I mean, the actual amount he has to exchange into. So
Okay.
800,000 is the price that he sell, and 100,000 is the cost of the sale, and then he have 200,000 loan.
Okay. So by selling costs, I'm going to assume that refers to realtor fees and escrow fees. Obviously, on $800,000, it should be less than 100,000, but I'll play along with those numbers. So after you subtract the 100 from the 800, what's left is $700,000. That's referred to as the net sales price. So again, it's net of closing costs. So that's realtor and escrow fees. So if the net sales price is 700, then you need to buy at least $700,000 worth of investment real estate. So yes, there was a $200,000 loan paid off. So there is $500,000 of equity of cash coming out. But if you only buy a property for $500,000, then you're going to pay tax on that incremental $200,000 because you did not replace all of it. And that now, whether that $200,000 is buying something all cash and not getting a loan, or whether you use some cash and got a $200,000 loan, it doesn't matter. The taxes are the same. If you sell for 7, but only buy for 5, you're going to pay tax on that $200,000 difference that you did not spend on.
Yes. So I think there's a follow-up question. So can he sell 2 and buy 1?
Yes, selling 2 or more properties to buy 1 is very common. The key thing, if you are selling multiple properties to buy 1, is that the 45 and 180-day clock starts the day the first property closes escrow. So if you're selling 2 to buy 1, you ideally want to try to close them relatively close together in time. I actually had a success story about this. I had a client who was selling 3 properties down in Los Angeles, and I was talking to him and his agent as a planning before they even listed them. And I said, well, the first one that goes into contract, ask for a long escrow. And that's exactly what we did. The first one went into contract. He asked for a 60-day escrow. 2 weeks later, he got into contract on the second one. 2 weeks later, he got into contract on the third one. And they timed the escrows where they're all closing within a week of each other. So that worked out very well. So that's the important part in when it comes to timing, is that the first one that closes starts the clock for everything. Let me just add to that. I have had situations where people are selling multiple properties, like 6, 7 properties, and they want to buy 1 replacement. Usually something like that complex, it is very difficult to get all of them to sell before they buy the replacement. So on those, we often end up doing a partial regular exchange and a partial reverse exchange, because they sell a few properties, then buy the replacement, and then do a reverse for the rest. So obviously, when we're getting into something that complicated, please call me. We'll go through your situation. We'll go through a planning process as to how you're going to do it. But there are strategies to get something like that accomplished.
Yes. Very good. So there's another question talking about like rehab. Is there a way to claim the rehab and improvement into the exchange? Is there any preferred strategy?
Okay, so I get this a lot. So the property that they want to purchase is a little bit less expensive, so they want to leave some money in escrow to improve the property. The answer to that is it's more complicated than that, because the day you take title to the property is the end of the exchange. So if you sell something for, I'll use the other client gentleman's numbers, you sell the property for 700, you want to go buy something for 600. If you want to spend the other 100 to buy that property, there is a special kind of an exchange called an improvement or build to suit exchange, where we take your money, we buy the property. So we will create an LLC, we buy the property and hold it. And while we are on title, we pay your contractor to do the improvements on the property. The key there is by the time you acquire the property from us, you get the property, those improvements will have been done. So you're actually now acquiring the full $700,000 property because while we were going through this, we did the improvements. Now, this is a more expensive transaction. It's probably going to cost around $8,000 or $9,000. So it usually is something you're only going to do if you're spending at least $50,000 worth of improvements. And the other thing to note is that you are still bound by the same 180-day rule as a regular exchange. And the reason that's important is we cannot build a hotel like somebody asked me to last year as an improvement exchange. It's something that you have to get that work done, and that 180-day clock starts when you sold your property. So again, doing improvements on the property, there are strategies. If it's something simple like it needs a new roof, I suggest ask the seller to do it and increase the purchase price by that amount to reflect it. But if it's a lot of work, there are ways to do it. But the key is you can't buy the property and then do the improvements.
And also you have to close 2 escrow, right?
Actually, no, because what we do is we just assign the LLC to the client that way. By assigning them the LLC, we can avoid having to go through the extra escrow.
I see. So you don't have to close 2 escrow, just assign the LLC to the client. Okay.
Correct.
So, but the cost that you charge would be at least like $9,000.
$8,000 to $9,000, depending on a few factors. And if it's a big commercial project, obviously it can be even more expensive. But for residential projects, most of them are in that 8 to 9 range.
That's good to know. Very good. So you mentioned about the DST, the Delaware State Trust. Would you like to elaborate a bit more about it, and also what have to be watched out?
Okay, well, the thing about a DST, for us, it is a replacement property. So whether you go buy a house in San Mateo or a shopping center in Texas or a DST, for us, it is just a replacement property. But I'll say the DSTs are not sold by real estate agents. So unfortunately, Monica cannot sell it. They are sold by people who have a securities license specializing in what's called securitized real estate. And so there's a special type of broker who sells these. I know a bunch. Monica may know some as well. But these people will broker these properties. Again, the properties are put together by or are purchased by a company referred to as a sponsor, and these sponsors will then purchase a property and basically come to these dealers and say, okay, we have this property, here's how much revenue is generating, here's what we plan, how long we plan to hold it for, etc. And then you go to them and say, okay, I want an apartment building, or I want commercial, or I want government buildings, or whatever kind of property you want. You can go, and they're usually DSTs that are created around that. And the DSTs also, by the way, have loans on them, and that are not recourse. In other words, you don't have to get the loan yourself, but if there's loan to be replaced because you had a loan on your property, that's okay, because these properties have loans on them also. But the key is you are choosing which property you want to buy. And so if you're going to say, I'm going to buy $500,000 worth of, X apartment building in Texas, then we work with that sponsor to send them the money to quote unquote buy your share of the property. A lot of people will use the DSTs either as a backup in case the one they wanted falls through, or they'll use it as a filler. I did an exchange last year for a gentleman who sold a property for $1.3 million. He was only buying something for $1 million and had $300,000 left over and didn't know what to do with it. So he ended up buying a DST for that incremental amount.
Yeah. So it's very important to see what type of property, being that now with the high interest environment, commercial interests tend to be a bit high. So you have to really study the offering memorandum very, very clearly. And because the sponsor, they cannot do it for nothing, there will be management fee. At the back end, there's also a split. And also sometimes for DST, it's not very liquid. So in order to go into a securitized investment, you have to do a lot of due diligence, okay? That is something that we learned before.
Right. Yeah,
So,
that's exactly right. The lack of liquidity is probably the biggest negative for most people.
yeah. Okay, so I have a question from one of the attendees and say, how to purchase a new property that's more expensive than the sale of the sold rental property. So I think like because this attendee come in a bit late.
Yeah, but I mean, I would say that the vast majority of our clients do end up buying more expensive. So if you sell for $1 million, they want to buy something for $1.2 million or $1.5 million or $5 million. That's perfectly okay. Obviously, you need to make up the difference. Usually, people will get a loan to make up, the difference. Again, as we discussed, you can use your own cash, but I would say that the vast majority of our clients who do an exchange do end up buying something more expensive. That's perfectly okay as long as it's at least equal to what they sold. You can go up as much as you want.
Yes. Well, also, I have two questions, being that some of them are on my own and also some from my client. So regarding restriction in buying, selling to related party, I have like some clients say if they want to sell a property in out of state and buy in California, being close to the children, say, can their son-in-law buy a property on the behalf first? And then when they're done selling the down leg, the up leg, then acquire from the son-in-law. Is it considered a restriction, being that it's not immediate related?
Well, in California, because we are a community property estate, your son-in-law is considered to be related to you. Now, mind you, if everybody lives out of state and they want to do this, then probably okay. You intimated that they are moving closer to their kids, so they're probably at least the son-in-law, the daughter and son-in-law live in California. Because that's a community property estate, your son-in-law is considered to be related to you, and therefore that solution of having the son-in-law buy the property and then buying it from him will violate those related party rules. So my suggestion is one of two things. Either we do just a regular, we just do a reverse exchange where we buy that property and hold it for them. Again, assuming that the financing could work out. The other option is have the son-in-law buy their property in the other state. Because if the son-in-law has the money to buy this property, he probably has the money to buy their old property. And if he buys, so selling to a related party is fine. It's only buying from a related party that's a problem. So my suggestion there would be have the son-in-law buy their property in whatever state that property is in. Now they could do a regular exchange. They sold to him, they buy the new property, and then obviously now the son-in-law needs to find a buyer for that property. But whatever he sells it for is going to be, there's going to be no gain on the property because he had just purchased the property. So again, the key here is though that you're instead of having him buy the replacement property, you have him buy the one that they're selling.
Yeah, sounds like a good alternative solution. Okay, so when you talk about combined exchange, being a primary residence that have part of it maybe lease out rooms or lease out, use as an office, and then you sell in the back end, you can do a combined exchange. But like say in California, we have the new Proposition 19 that the owner can transfer the property tax base to a new property if they acquire. If they do a combined exchange, what's the chance that they can keep the property tax basis?
Very low, very low. And for many, because the problem is first off, once they move out, it's no longer their primary residence. And also when they do the exchange, they're buying also what's not a primary residence. So in many cases, depending on the long-term desires of the client, you have to look at the numbers. Ultimately the question is also, what did they buy in replacement? If they already owned another property, or they're moving to a senior community, or they're moving out of state where things are much cheaper, usually it's not that big of a deal. But if they're expecting to ultimately buy a property that they're going to want to live in again, then they need to look at the economics. Is the extra property taxes I'm going to pay for how much ever the rest of my life compared to the capital gains I'm saving by doing this combination exchange. So the answer to your question about being able to use Proposition 19 at the same time, the answer is no. It's one or it's going to be one or the other, and whichever one is the best for the client. They need to do their own analysis for that.
Yes, got it. Okay, so going back to about like property tax basis. Say if like parents and child, they co-own the property, say if the property now is $2 million, each one own 50-50. So if the parent transfer their $1 million, 50% to the kid, do you think it would be trigger any kind of property tax changes? Because they eventually they want to, instead of like doing a 1031, they just want to get the money out.
So if the children are not living in the property, then the transferring a portion of the property's ownership to the kids will trigger an increase in property taxes. The only way to transfer property taxes to your children and they get to keep your old property tax base is if it is the parents' primary residence and it is the kids' primary residence. I will also note, if the kids move out, the property taxes go up. So it's not the day you buy it, it's permanently. The day they move out, it no longer qualifies as a primary residence. Then they will see a jack up in property taxes. I am not a fan of adding children to title on a property for a few reasons. One, we just talked about the property tax situation. Secondly, if it's not done properly with the proper tax filing, it could actually create what's called a gift tax, which actually could be as high as 35%, not to the kid, but to the parent who gave it to the kids. So you want to make sure you have good tax advice. And also, because what you're precluding now is you're precluding your kid from getting what's called a step up in basis. And so usually from a tax perspective, it's much better to inherit the property than it is to have it gifted. And a lot of people say, well, it's just easier to add my kid onto title to the property. Yeah, but you know what? In the long run, it's going to cost them more money. I would suggest spend $2,000 or $3,000, get a trust done, have them as a beneficiary. That accomplishes everything you want and is much, much more tax efficient. Not to mention, I had a situation not long ago where a woman had added her son to title on a property, and all of a sudden, he didn't get along with her anymore. She wanted to sell the property. He didn't want to sign. So they had to hire lawyers and stuff like that. And I know everyone says, oh, my kids and I get along, no problem. Yeah, but sometimes things happen.
Well, like alternatively, if they set up an LLC, each one own 50% share. So if the parents pass away and then, the son get the rest of the LLC, well, is it going to be the step up again, or like say, will an
exact same.
entity make anything changes?
No, whether you own an LLC or own your name, it's the same thing. Because remember, the LLC isn't a tax entity. It's
pass through.
It's considered it's pass through. So what'll happen is whether it's in your name or whether it's in the LLC, they'll still just get the half step up in basis as opposed to a full step up.
I see. And that applies throughout the nation, right? Not in California, but
Well,
also in other states.
This is federal law.
I see. That's very good to know. Yeah, because like say we got all these questions all the time from clients, and then we definitely will have them reach out to you regarding exchange, because many of the clients are thinking about like maybe reducing the portfolio. They don't want to manage. And now, but of course, if you say it would be better to wait for the step up, then they have to exchange in something maybe not so management intensive.
Yeah, no problem. Again, I'm here to answer questions as this develops, especially if I've confused anybody, because I know I talk fast sometimes. So I'm happy to answer any more questions people have about their specific situation.
Yeah, very good. Yeah, that's very informative. We learn a lot, Ron. Thank you very much, everyone. And we have this presentation recorded, and the PowerPoint will be also shared with everybody who have registered. And we're going to put this particular presentation on our YouTube channel. Thank you, Ron, again, for this precious time on a Saturday.
Thank you for having me. You guys have a great day.
Yeah, you too. Thank you, everyone. Yeah. See you next month. Thank you. Bye-bye.